3rd of August, and you're listening to Kopi Time, a podcast on economies and markets from DBS Group Research. I am Taimur Baig, Chief Economist. Welcome to our 24th episode. Today, we are privileged to have access to a highly astute analyst from a highly regarded sovereign wealth fund. Dr. Prakash Kannan is Chief Economist and Head of Total Portfolio Management at GIC. GIC Private Limited, formerly known as Government of Singapore Investment Corporation, was established in 1981 to manage Singapore's foreign reserves. Prakash is currently responsible for medium-term global macro and asset allocation strategy for the firm. He also serves as a member of GIC's Currency Risk Management Group. Prior to GIC, Prakash was with the International Monetary Fund in Washington, D.C., where he was a member of the World Economic Outlook team. He started his career at the Central Bank of Malaysia during the Asian financial crisis and has also worked with GTE, now Verizon Pension Fund. Prakash Kannan, welcome to Kopi Time.
Hi, thank you, Taimur.
Great pleasure to have you. Prakash, why don't we start with you giving us a sense of what GIC does for those who don't know, and tell us also what you do there.
Sure. Well, firstly, Taimur, I just wanted to congratulate you on Kopi Time. I think it's a great success. Very nice for you to have gotten it off the ground. So GIC, it's one of two main sovereign wealth funds in Singapore. We're established roughly about 40 years ago now, and we have expanded quite significantly since then. So we've got offices in about 10 different countries. And we really kind of cover the whole gamut across public as well as private markets. I would say if there's one thing that we pride ourselves very much on, it's really our long-term orientation. And I would say that that culture really pervades everything that we do, both in our investments, but also just in our organizational culture. So within GIC, I'm the chief economist of the organization. And also the head of a group that's called Total Portfolio Management. I would say the role is kind of has two dimensions to it. So the first one is really to help map out the forward-looking investment environment for the organization. So this includes basically what we think about some of the key macro variables, growth, inflation rates, etc. But also, some sense of forward asset class returns. Then the second dimension is really about helping senior management with asset allocation decisions. And so here is where our long-term nature really comes into play. So our horizon that we kind of base our strategic asset allocation, so it's over a 20-year horizon. So it's really kind of, forces us to think about some of the scenarios that could play out over such a long horizon. So that's kind of in a nutshell of what GIC is and my role in it.
Right. Prakash, you have a long-term investment horizon, but at the end of the day, you follow the conjunctural very closely as well. You just published your annual report, and there is a feature article there. The first sentence of the feature article is the global community is facing a public health crisis, an economic crisis, and financial turmoil all at once, an unprecedented combination in modern times. So we will talk a little bit about that unprecedented combination here. Let's begin with the first theme in that feature article, your sense of the macro environment, and maybe you can walk us through your views on the key economies like US, EU, China, and perhaps also ASEAN.
Sure, happy to do that. In general, every time when we release the annual report, the focus is usually on returns because that's kind of one of the key metrics we have. And so this year, it really is about a message of resilience. And we have steady long-term returns that kind of beat global inflation. And it is against that unprecedented backdrop that I think the feature article was written. When I think about the recovery, really there are four drivers that I see. The first is about virus management generally. The second is the structure of the economy. And so this is, how much is the economy dependent on manufacturing versus services, on external demand versus domestic demand. Then the third dimension is really about the policy stimulus that has taken place. And then the last one is about any kind of existing economic imbalances. So you have these four drivers. And in general, we've found that the first two, which is how well the economy is both able to and as well as in reality handling the virus, as well as the second one, which is the structure of the economy, these two end up being kind of the biggest drivers in how we kind of rank countries along the recovery path. And if you look at both of those two factors, China actually scores relatively well, right? So they have really gotten ahead of the virus. There is a little bit of a first in, first out principle with China, and even as kind of new outbreaks have been happening, they really have been responding to them quite well. And then also I would say having a large domestic economy in China has been helping. They have been pushing a little bit more on the supply side as opposed to domestic demand. But I think on both those measures, China has been scoring relatively well. Generally, I would say that extends to North Asia, so Taiwan, even Korea to some extent. I think scores well on that dimension. I think the part of the world that is really challenged, even when you look at those four criteria, I think is Latin America. And here, I think obviously they are experiencing winter right now, so there is a much more of those indoor behavior, etc., that could be exaggerating some of the virus cases. But places like Brazil, Chile, etc., the numbers still look quite worrying. And as we kind of go a little bit into some of the secular drivers that we also talk about in the annual report, if the kind of pace of globalization also starts moderating, then I think some of these economies that are a little bit further away from big geographical centers such as China, as the US, I think they would tend to suffer relatively more. I think if the headwinds to globalization do really end up being quite strong.
Right. Prakash, that last point, I just want you to talk a little bit about it. There was a time when global trade GDP rose steadily, but that was not till recently. I mean, kind of stopped around 2008, 2009, global financial crisis, lost a lot of ground, began to pick up very slowly, and then got again undermined by A, the trade war, and B, the pandemic-induced global slowdown. So the countries that haven't prospered on the back of globalization, and we have a lot of aspiring emerging markets, let's say like the ones like India and Indonesia, should they sort of give up on that strategy? Because over the long term, if that trajectory remains flat and countries like China remain competitive, what chance do the new entrants have to leverage off of globalization?
So I think it has been proven both theoretically as well as empirically that really kind of making the emphasis on export-led growth is really the best chance, I think, for a lot of these economies, both to create jobs at home, but as well actually to increase productivity. I think if it's interesting when you look at the kind of public attitude towards globalization, actually you find in Asia generally the attitudes towards globalization, especially in terms of goods, is actually very high. Where a lot of people do think that globalization is a force for good, I think, in this part of the world. And so when you look at even at economies like India and Indonesia, I think that really still is the best strategy for these countries to really lift up the living standards. I think it becomes more challenging when it's globalization of services, and especially globalization of labor. And I think here's where some of the challenges which we have seen in the developed world are also a little bit relevant for these countries. But in terms of manufacturing, getting jobs, really kind of lifting these economies up, I think that strategy still has room to run.
Right. Coming back to the sort of near term, because some of the sort of shortfall in demand, they're so large that if we don't have a big V-shaped recovery, this could sort of lead to a major sort of arithmetic impact in terms of the recovery path and keep us below the level that we saw last year for a very long time. And since in your report you do talk about the intersection of financial risk along with growth risk and pandemic risk, Prakash, there will be industries that would face massive headwind through the pandemic, and even in a post-pandemic world, they probably will not see the demand that they saw before, and therefore consolidation is inevitable, even if some stimulus and support measures related Band-Aid is in place right now. And then there's the issue of the balance sheet risk, which also you have been highlighting for a while, the ballooning global debt burden. So share with us your view on these two issues, the kind of industry consolidation we can see in the coming quarters and years, and the balance sheet risk that is out there both at the corporate level and sovereign level.
Sure. I think on the industry consolidation aspect, I think it's probably not surprising to hear that this crisis has been having an uneven impact on small and medium scale enterprises. I think we've seen research, at least for the case of the US, where there's been about 12% of SMEs which have basically closed their business for good. Default rates have also started to pick up. So it's as you said, probably inevitable that in some of the harder hit companies within hospitality, retail, etc., some form of consolidation is likely to happen. I think the challenge here is that a lot of the risk is being transferred onto the balance sheet of the sovereign. And I think this has a few implications. I think the first is it's a question of divergences across countries. And so, some countries, obviously the more developed economies, the ones which have reserve currencies, they are much more able to bear this risk transfer than some of the emerging and especially developed economies. And so I think here, this risk transfer and that intersection of small, medium scale with countries that do not have this kind of policy space, I think that's where the risk of quote unquote permanent impairment, I think, lies probably the largest. Whereas I think in some of the developed economies where you can have this risk transfer, the challenge becomes when do you how do you wean companies off of this dependence? And so I think you will start to see a series of these kinds of so-called fiscal cliffs, where either programs start expiring, and then suddenly you find that companies need to bear the burden of these higher debts on their own. And so I think that those two divergences, one across countries and one between the private and the public, are going to be very important. So here, I think the move by the G20, as well as some of the other private debt reorganization efforts, I think are absolutely essential. because for the low-income countries, developing countries, they're going to find it very difficult to shoulder this burden, and so some kind of relief, I think, will become necessary. And so I think even as we go into 2021, this higher debt issue will definitely be one of the legacies which will have very long tail effects.
Indeed, Prakash, one thing that I worry about is the likely politicization of this debt relief, because I fear that, particularly with the US having such a strong influence in the IMF, World Banks of the world, that any type of Paris Club type restructuring would come with the US insisting that there's a bilateral debt relief from China to all the countries that have borrowed under Belt and Road Initiative, and that could probably muddy waters. Do you have a view on that?
No, I mean, I think definitely over the last few years, China has become a very important creditor, I think, to a lot of these countries. I think actually they have started to make efforts at, kind of quasi-moratorium on some of these bilateral debts. But I think you're absolutely right. I think insofar as any of these efforts are likely to succeed, I think China has to play a very important role.
Right. In your section in the annual report, you also talk about the paradigm shifts in policymaking. Both fiscal and monetary are supercharged already around the world. And then you highlight a couple of risks. One is the increased risk of higher inflation over the medium term, and then the risk of currency moves affecting asset returns. Why don't we weigh in on those two issues?
Sure. When we were writing this report, we realized that actually, this issue of post-COVID trends is probably one which many commentators globally have already talked about. So we're really trying to think about, what value can we add to this debate? And I think from my perspective, I think the one really underappreciated change, which I think is likely to be with us for a while, and especially for investors, I think he's going to be the key post-COVID trend, is really about this paradigm shift in policies, and I think there are a few aspects of this, right? So the first one is really kind of you can think about it as an acceleration of a trend that was already happening
right
a couple of years before, and which is that central banks, especially the major central banks, are really moving along the path that they are going to be changing their reaction function. And so, while we're all very used to a central bank which hikes interest rates in anticipation of higher inflation, I think this time is going to be very different. Central banks are actually going to commit to being behind the curve. They are probably going to encode higher inflation into their new strategic reviews. It's not just happening at the Fed, also at the ECB. And so this change in their reaction function, I think, is very important. Then the second one, I think, is on fiscal, and here, I would say the change is really that there's a lot more, call it ambivalence or a little bit more acceptance that the lower interest rate environment really changes the dynamics on debt sustainability. And I think this change is very important for especially places where in the past that political pendulum always tended to swing back towards austerity after you experience such a big fiscal expansion like this. And I mean, we only have to go back to what happened in Europe, 2011, 2012, where the push towards austerity was very strong. I think that's changed. I think that policymakers and across the ideological spectrum, right, are willing to actually tolerate higher deficits, tolerate higher debt levels, and I think this is also a very meaningful paradigm shift. Now, what are the consequences of that? I think the consequences are a few. So we list out two in the annual report. One is, probably for the first time in many years, I think the risk of higher inflation is meaningful. And here it's not just about inflation, going to 2 and 2.5, but actually even going to 3 and above. And then the second one, I think, is that it does create more fragility, I think, on the part of the balance sheet of the sovereign. I think there is a increased reliance on the belief that interest rates will always remain low. This need not necessarily be the case. You could have the next crisis being one where, for some reason, whether that's because of increased risk premiums or because of inflation shocks, where actually interest rates start going up, and then suddenly your debt dynamics become a lot worse. And so, these two things I think are very important, at least for investors like us, to really think about how we should price assets. And the reason I say that is because I think there is a belief that lower interest rates automatically translates to a lower cost of capital, and then that could justify higher valuations. Whereas we think that, cost of capital also has an equity risk premium embedded inside there. And given, that you not only have a riskier world going forward, but also that, the longer term growth has been impacted somewhat, that these need not necessarily cancel out. And so, I think this changes in the policy paradigm. If I was to name one thing that I think is probably the most meaningful for investors to deal in this post-COVID environment, I think that would be it.
No, absolutely, Prakash. I fully agree with you. The way I sort of look at it is that there's a reason rates are low, because long-term potential growth rate is declining. Therefore, the return on capital is declining. So I hear in the markets, everybody talks about low rates and there is nothing other to invest, and therefore the equity risk premium could be justified. But at the same time, at some point, earnings matter, and earnings are a function of nominal growth, which is a function of real growth and inflation. And we may end up getting some inflation. I'm still unsure about how we're going to get any meaningful growth to make all this work out. So that takes me to the hot button question of the moment. Are equity markets in a bubble, Prakash?
Well, that's I actually came across some academic articles which are still debating whether the 2000 equity bubble does that even constitute a bubble. Look, I mean, I think these things are always difficult to call, and I think it's a little bit. Even interesting that we can actually entertain a question when we're faced with a pandemic and the GDP is seeing record contractions globally. That could even be a bubble. So I think where most people are worried about, I think, is really kind of a subset within the equity universe, right? So if you look at broad indices, I think outside of China and then Nasdaq and I guess slightly S&P, but most markets are still trading below their all-time highs. But I think you definitely get some pockets of exuberance in global tech, and particularly kind of large cap tech. And this is not just a US phenomenon. I think you see it also in China. Some of the big tech names, and even some of the smaller ones like Meituan, etc. Some of their price trajectories really has gone parabolic. And I think this in a way goes back to our earlier point, which is that it's typical in an environment where you don't see growth coming, that the market really chases after whatever growth there is, and so here it really is the tech companies who arguably have been the beneficiaries from this pandemic. And then at the same time, you have this kind of lower interest rates, where a lot of these companies you can see them as kind of long duration assets, and so they do benefit disproportionately when interest rates fall. From our perspective, obviously we are invested in these tech companies, and we have kind of enjoyed the performance, and they really are in general very good, very well run companies. But I think where we're a little bit more concerned is kind of the periphery around these big tech companies, where I think you are starting to see very exuberant growth projections, and there is a lot of extrapolation that companies can either be the next Google, the next Amazon, etc. So you are starting to see, I think, some froth around the edges, and so as an overall portfolio, GIC is still very cautious, very defensive, because our mandate is kind of twofold, right? We not only enhance the value of Singapore's reserves, but we also have a mandate to preserve the value of reserves. And one of the indicators that we use for which there can be a higher risk of permanent impairment is if you really buy at a very high price. And I think that's one thing which I think, at least for this subset of companies, I think you are seeing those levels.
Absolutely. Prakash, from equities to currencies. Now, again, some of the very short-term dynamic, but this could be the beginning of some sort of a long-term trend as well, which is the US dollar. For the longest time, every time there is a risk aversion related development around the world, global investors flock to the US dollar. And we saw this as recently as in February, March, when the dollar spiked at a time of the first set of worrying news about the pandemic was spreading around the world. But since then, it's coincided with a rally in gold, easing off of the US dollar, especially against the euro, but also against other major currencies, not against emerging markets yet. Your thoughts on the currency markets?
Sure. Yeah. We actually highlighted this as one aspect of the consequences of the paradigm shift, which is once you have interest rates all falling to close to kind of an effective lower bound, currencies are going to start playing a bigger role in determining total returns from investing. With regards to the dollar, actually most of our valuation metrics just show a pretty mild overvaluation. So it's not what we had, let's say, in early 2000s, when the US was running a current account deficit of close to 6% at that point. So yes, there is some headwind from valuations, but not that meaningful. I think the interesting thing sometimes we think about the dollar is not so much what happens in the US, but actually what happens in the rest of the world. And so, if we do have that scenario where the rest of the world growth really takes off, and so where there's some notion of confidence that returns, and going back to my kind of 4-factor framework, that whether you think that the impact of the stimulus in some of these economies start improving, the virus gets better managed, all relative to the US, then I think you could see actually the dollar kind of depreciating in line with kind of better global growth. Unfortunately, that's not our baseline scenario at the moment. We think it's still going to be a stop-start trajectory. I think at least for the next year or so. I think at this point we really hope that the virus is not seasonal, because if it truly was seasonal, then in the fall and the winter we may see another spike up in cases, and so because of that, I think yes, the dollar probably still has a bit of room to depreciate, but it's not a meaningful downtrend from where we are today.
Right, and you correctly said it really depends on the rest of the world, particularly with respect to the euro. I think this big 1.8 trillion euro fiscal package that got formalized late last month, it certainly has put some tailwind behind the euro, but at the same time, the outlook for the eurozone is by no means clear sunshine. And hence, I think it would take a very brave investor to be outright positive the euro against the US dollar over the longer term. Prakash, from FX to rates, of course, negative rates are the most striking characteristic of the developed market debt market. Just unbelievable the amount of outstanding paper with a negative yielding coupon. What's driving this spread, and how will this all play out over the long run?
Yeah, that definitely is something which I would say maybe even 10 years ago we probably thought was unimaginable. I think at the end of the day, it's a question of it's two things. One is that how much equilibrium rates have fallen, and then second is whether central banks have been willing to cross that Rubicon into negative rates on the policy rate front. I think on the first point, I would say that equilibrium real rates have fallen probably globally, and so this is true. I think even in the US. But I think on the second point, it's only the I would say the Japanese, well, the Europeans first, and then the Japanese, where on the policy side they have decided to cross that Rubicon into negative rates. The US hasn't, and in a way, there are still some, I would say, legacy issues on the money market side, which makes it a bit more difficult. But that has kept the 10-year rate in the US relatively better supported, right? Because I think once if the Fed signals that it is willing to go negative, then that changes the distribution of rates all over the curve, and so that will meaningfully impact rates even at the long end. But I think the fixed income investors, for them, the curve matters a lot more than the level of rates, and so at least for at some point in the past, when the European curves were still relatively steep, not many of them minded negative rates, because for a kind of a levered bond portfolio, you were still getting kind of decent carry and roll that compensated you for the negative rates. I think that's changed a little bit now. So curves are flat all over the world, and I think what the consequence of this is that people are getting pushed into riskier assets, and so I think fixed income, especially sovereign bonds, used to play this very unique role in a portfolio, because not only did it give you protection, but it also paid you for it, in the sense that it was able to give you income. I think going forward, most asset allocators are going to have to split that role. So they're going to have to seek income from a separate source, and this could be, high quality credit, or possibly even high dividend paying stocks. And then they're going to have to try and find protection from somewhere else. And so I think this kind of splitting would likely be the trend that happens.
Well, Prakash, you touched on credit, so we'll transition there. We have seen credit spreads narrow substantially in developed markets. We're basically back to pre-pandemic levels. It hasn't compressed as much in emerging markets. But at the same time, as you and I have already talked about, that there's considerable uncertainty about growth and returns. And yet investors seem to be lulled by the wall of liquidity and have great deal of comfort in holding these assets paying very low yields. Geographically speaking, you're comfortable with the credit outlook, in China, US, Europe?
Yeah, so I think especially when you take the all-in yield for credit, so, not just the spread, but also how the base rates have fallen, you're seeing kind of record low yields across the credit spectrum. And so, at least from a top-down perspective, as you said, going back to some of the risks we've been talking about, you're not getting compensated, I think, for the risks. And then I think the second thing to think about is just what are your thoughts on recovery values? I think what we have been more concerned about is just that when you look at the overall debt levels, we've been concerned that actually recovery values may not be as high as they used to be historically. So they could just be in the 20 to 30% range rather than something much higher in the past. And so, you've got to factor that in as well into how much compensation you require. So, our strategy, at least in-house, has really been about kind of staying away from the broad indices and actually kind of, going in at the company level. And here, I think, you still can find good names that you think will be money good at the end of the day. And so, it kind of almost goes back to investment 101, where you're kind of underwriting company by company, looking at the balance sheets, looking at the fundamentals, and I think that has to be the way to do it, because I think the broad index, I think, kind of covers a lot of variation within the index. And you could find an environment where, yields blow up such that they wipe away, let's say 5-6 years of carry in a very short span. So unless you're really comfortable with the names that you're holding, I think it could be a very challenging environment.
And absolutely, it's going to be challenging, Prakash, because with the government's role expanding substantially in the way the economy will be managed going forward, they will also have a lot of say in restructuring of large corporations and industries. And I cannot imagine the public being very sympathetic to making credit investors from the private sector whole, and therefore there'll be pressure for further haircuts and so on. Something that I feel, again, the market is fairly oblivious of at the current juncture, whereas I think anybody who sort of recognizes that the government's role will increase should probably be a little more cautious. I want to switch to something not at all conjunctural, but more of a broader issue, and that is to deal with sort of GICs, both mandate and views on sort of the investments, which is broadly known as ESG, so sustainable investment, or things that meet high degrees of environmental, social, and governance-related criteria. What can you tell us?
Yeah, sure. I mean, I kind of started off the conversation highlighting our long-term focus. And so, in that sense, I would say sustainability is kind of really core to our mandate. When you look across the E, S, and G, I would say at least elements of governance have been, probably one of the number one criterions from our investment philosophy, almost from day one. And so that that it's really kind of been wired into our DNA, and that roughly translates to a belief that that actually companies with stronger sustainability practices will generate better risk-adjusted returns over the long term. And so, I think this notion that that there could be a trade-off, I think, may be true for shorter-term horizons, but at the end of the day, we think that these two things are consistent with each other, and I think they're going to be increasingly so when the rest of not only the investment community, but I think the broader stakeholders demand that. And so these two principles of kind of being long-term oriented nature and sustainability, I think they're just going to merge with each other. And so what we have done is we have this kind of a three pillar framework, which the first one is called offense, second one's called defense, and then the third one is we call it excellence, but it's kind of more organizational in nature. So on the offense side, it's really about how can we capture opportunities? How can we kind of get ahead of the curve? And so that is, we've got internal efforts about trying to invest in thematic opportunities. So this is everything from renewable energy, and then our real estate business, for example. These guys have really been ahead of the curve when it comes to this notion of green buildings, etc. So that's been a big push as well. And then all these other technologies that kind of support transition to low carbon economies. That's also been a big push. So a lot of things I think on the offense side, and then on the defense. The defense, I think, is really looking at some of our existing holdings, particularly those that just kind of sit in benchmarks. And so, this have everything to do with physical risks, that kind of could lead to potential stranded assets, etc. And so, I would say probably since about 3 years ago, we started regularly screening our existing portfolios. We've actually also started actively engaging our portfolio companies. Just kind of, at least for the bigger companies, kind of maintaining that regular dialogue with senior management, boards of directors, etc. Voting responsibly on some of these issues. And so I think on a lot of these efforts, at least looking, kind of taking a more serious look at things that we already own. And then the last pillar, this kind of excellence pillar, is like I said, really about our own organization. So I think, it's not enough to just push the ESG lens through either the things we own or the things we want to buy, but I think we've got to push it through our own institution. And so here, it's everything about cutting down the use of non-recyclable materials. We've improved the energy efficiency of our buildings. In fact, we've actually trying to become carbon neutral, I think, in our operations by the next financial year across our 10 global offices. And then even in some of our business partners, we've become a lot more strict about what we expect from them. We don't enter into contracts with those that don't meet our standards. So I think it's really been a very comprehensive effort on all these dimensions. And to be honest, I would say it's one of the few issues in GIC which is really kind of motivational almost. So I think some of the younger staff, when they join, you could argue that they even demanded from us, and so it's been actually quite an interesting journey, at least over the last 3 to 5 years.
Prakash, we see very similar thought processes within DBS too. So nice to know that we're at least aligned on that matter. Thank you so much for your insights. Greatly appreciate your time.
No, thank you, Taimur. I was enjoyed the conversation.
Me too. Thanks to also our listeners. Martin Taki produced Kopi Time, which is available on YouTube and major podcast platforms, including Spotify, Apple, and Google Podcast. You can also find our live streams, webinars, and research publication by Googling DBS Research Library.